there's been a lot of talk about, new administration. A lot of people are paying attention to tariffs and trade for kind of the first time in a long time. And we get tons of questions. Okay, yeah, what the heck is going to be going on with that? And so we decided to bring an expert on. And the expert, Jack, tell me how to pronounce your last name. This is embarrassing. If I had not had a show right before our show, I would have asked you, but I just didn't.
Jack Caporal.
Jack Caporal is here with us. Jack does a whole bunch of work with us on the research side. So the Motley Fool does some of its own research. I mean, like any company that reports news and delivers information, we do rely sometimes on third-party surveys and things like that. But at some point, we were sort of like, you know what? Why shouldn't we? Who can you rely on better than yourself? And so bringing a little bit of this in-house and developing out the Fool's research capabilities seemed like a good idea. And Jack has done an extraordinary job, along with a team of other folks, to try to play this out and to kind of put a foolish spin on topics of the day, things that investors, that members are interested in knowing, things that can educate, amuse, and enrich. So, Jack, let me just open things up, just to ask you a real general, open-ended question, and kind of ask you, what motivated you to do these types of research topics? How did you pick, out of all the questions that we get, how did you decide that this was something that we wanted to go into, and tell us a little bit about the research that you did?
Yeah, Dan. Well, in a previous life, before I joined the Fool, I worked on trade policy issues in a pretty in-depth way at a think tank in Washington, D.C., at the tail end of the Obama administration, and then for most of the Trump administration. So after the election, my radar started pinging. I was like, these issues are going to come back up again. Investors cared about them last time. They're going to care about them again. And I think some of the issues that plagued the decision making in the last administration are probably going to be resolved. And I think we're seeing some evidence of that. So we're going to see a more full-throated trade policy. And I think that's what we've seen so far. How did I pick the topics? I mean, we've published a few kind of short, big picture articles that I think are informative for readers so far about where things are headed. So we've looked at the U.S. trade balance with every single country and our top 5 trading partners through a historic lens. And that's important because in its decision making, the administration has said that the U.S. trade deficit, is something that will inform actions that it will take, right? So if we have a trade deficit with another country, it's fair to suspect that some action might be taken. And we can talk about deadlines and ongoing kind of issues that investors might want to be tracking on the policymaking side, where the trade balance might play in. We've looked at steel and aluminum imports from our major steel and aluminum trading partners. Obviously, that's important because last week the administration imposed a 25% tariff on imports of steel and aluminum, including derivative products. And they also did away with all of the agreements that had been previously struck to provide exemptions for our major trading partners in metals. So that issue is live. And then we've also put together a tariff tracker where folks can easily see all of the ongoing policies, either implemented or under consideration, which country would be targeted or which product would be targeted, key dates, and what the potential outcomes can be. And folks can find all of that on fool.com/research.
Jack, where do you want to start? You want to start with the trade balance one?
Sure. Yeah, we can start with the trade balance. So I put together a couple slides here, some back of the envelope math, plus some data from World Bank and a few other sources. So what this map shows is the average applied tariff rate for each country. And the lighter the color, the lower the applied tariff rate. So this is the average duty that's collected on all products that enter into any country on the map. And The current U.S. average applied tariff rate is actually 1.5%, super low. You'll see one of the themes that's apparent on the map is that more developed countries have lower applied tariff rates because when these rates were negotiated at the World Trade Organization in the 90s, developed countries felt less of a need to protect certain industries from competition, right? So they have generally lower applied tariff rates. Our top trading partners, Mexico, Canada, China, even much of the European Union, all has a common external tariff. They all have average applied tariff rate within 1 to 2 percentage points of the United States. And so what does this really high level information show us? That when the administration does apply tariffs, particularly as part of its reciprocal trade investigation that's ongoing, and for which action should be announced at the beginning of April, it's more likely that they're going to focus on specific products than across the board tariffs. So an example of that would be, we're not going to put a 50% tariff, let's say, on all automobiles from every single country. Instead, or a 50% tariff rather on all products from the EU. Instead, we're going to look at a specific differential with a product that the U.S. has a trade deficit with Europe, and where the Europeans have a higher tariff. So an example of that would be automobiles. We import a lot more automobiles from Europe than we export to them. The U.S. tariff on automobiles is 2.5%. The Europeans have a 10% tariff, right? So I think one takeaway from this big picture piece of data is that we should expect fewer across the board blanket tariffs like the administration has done with Mexico, Canada, and China, and more specific fine-tuned tariffs now that the decision making is slowing a little bit and we're getting into some of the more in-depth investigative work that the administration has ordered versus, these are the fights that I immediately want to pick.
Let me ask you a follow-up question on that,
Yeah.
Jack, because it plays automobiles has been something that has been it's front and center in a lot of ways. One, because the tariff battles with the U.S. and Canada, a lot of automaking activity kind of crosses the border up by Detroit and Windsor in southwestern Ontario. And so, like that has been kind of a touch point. And, I do recall, President Trump, I think at some point last week was talking about Europe, about the EU, and saying, basically that the tariff situation, and I don't know if it was just talking about tariffs. My suspicion is that maybe on top of tariffs, that there may be some kind of like formal per unit or unit volume quota limitations that supplement that are on top of that, where it's basically, we're the EU and we're going to charge a tariff on what we let you export into our market, but we're only going to let you, irrespective of that, we're only going to let you export a certain number of vehicles, period. Is that, have I just misrepresented what's going on, or is there sort of a different arrows in the quiver of, if you want to make trade policy, like there's different things you can do, and tariffs are really just one of many things that you can do with it?
Yeah, totally. So let me jump here to this slide on autos. So
Awesome.
on the left-hand side, you'll see which brands are the biggest, send the most cars to the US as a percentage of their sales. So you'll see German, European, and then Asian brands, of course. And then much lower down, Stellantis, Ford, GM, the American brands, because they are more likely to have a larger assembly footprint in the United States. They definitely do assemble some lower margin vehicles in Mexico, and have some assembly in Canada as well, but most of the assembly for them is taking place in the United States. And then you look at the auto trade balance. So this is data through November on the other side. So huge trade deficit with Mexico, That is, to your point, Dan, and also Canada, that's super misleading because this data just looks at the trade balance of the final assembled vehicle. But vehicles that are sent to the United States from Mexico and Canada, most of them comply with rules of origin under the US Mexico Canada Agreement, the NAFTA successor, which says that for a vehicle to enter the United States duty free from Mexico or Canada, 75% of the vehicle's value of all of the parts in the vehicle, 75% has to be of North American origin, right? But when the vehicle crosses the border, if it's assembled in Canada or Mexico, it counts against the overall deficit. But to your point about tariffs being one arrow in the quiver, so if you look at Japan, Korea, and then the EU countries, Germany, obviously a little, Italy a little bit, the issue with the trade balance there is not necessarily tariffs. So the tariff differential, like I mentioned, between the US and EU for automobiles is 2.5% tariff on the US side, 10% tariff on the EU side. So the tariff on the EU side is an issue. The larger issue is that the Europeans use a different automobile safety standard to certify vehicles to be safe to drive in the EU. And for a company that's producing vehicles in the United States where there are different safety standards, it doesn't make sense economically to set up two manufacturing lines in that facility for the same vehicle, just so you can comply with different rules about headlights, so you can comply with different rules about seatbelt anchors, so you can comply with different rules about advanced safety features, etc. Right? So the Europeans, the Japanese as well, and the Koreans as well, all have a regulatory net essentially that makes it much more costly for cars manufactured in America to be sent abroad, and those aren't new issues, right?
Yeah.
Those have been issues for a long time. It's part of the reason why the trade balance is the way that it is. It's part of the reason why you have companies like Toyota and Honda manufacturing vehicles in the United States, as well as European companies. They have their own assembly plants in the United States and in North America.
Right.
But it is an issue that the administration is definitely keyed in on. They have a reciprocal trade policy investigation underway, which with action to be announced on April 2, where they're looking at the trade policies or policies that affect trade from every single country around the world, not just tariffs. So they're looking at non-tariff barriers, which are like the regulations that I just described.
That's good.
And they're going to try to ascribe economic value to those policies to create a balanced tariff, right? So what is the tariff value of the EU's auto safety regulations? And that is really an unprecedented approach to trade policy, just because that type of analysis there's mountains and mountains of regulations to comb through for every single country. The economic impact isn't always super clear. And it's one that I think folks should really be tuned into because the outcome could be pretty unpredictable. Like I said, it's unprecedented to look at regulations like this, non-tariff barriers like this, and say, I think that barrier is equivalent to a 10% tariff. And so that's what we're going to apply on that product to make trade reciprocal.
Got it. Okay.
Yeah.
Thank you for letting me kind of take you on that a little aside there in your presentation. So I guess, take us to the next step, I guess. So if do you have another slide on this, or do you I'm hoping that we can get to this is the map that I was kind of curious to see, I think.
Yeah, so what I've done here is just a little back of the envelope map. So I've looked at the average applied tariff rate for each country. I've looked at the US trade balance with each country, and then ascribed a risk score for each country based on how large the trade deficit is with the United States and how large the average applied tariff differential is. right? So a larger trade deficit with the United States and a larger, higher average applied tariff relative to the United States would get you more into the red category. And so this is, like I said, back the envelope map, but I think should give viewers an idea of some direction that the administration might take with its reciprocal trade approach. And it's a pretty curious outcome. You see only one country is at the extreme end of the spectrum, which is India. We have a pretty large trade deficit with India. They also have a very high average applied tariff rate because they joined the WTO and they negotiated their bound tariff rates. They were very much a developing country and just had much higher applied tariffs. So you saw when the Prime Minister of India, Modi, visited the White House maybe a month ago, trade was definitely top of mind. They talked about trying to strike a trade agreement. And there was definitely what appeared to be some horse trading also with like defense issues and trade. And you got a sense that this is something that the administration is focused on. There are a handful of countries kind of in the high risk kind of 3-score category. Also a lot of developing countries, so a few in South America, quite a few in Africa. These are not countries that we have huge trading relationships with. So even if there were action to be taken against them, wouldn't suspect that it would have much impact on the U.S. economy or the market in general. There are a number of countries that are kind of in like the middle risk category that we actually do have sizable trading relationships with, right? So obviously Canada and Mexico stand out, and we've heard the administration weigh in on that quite a bit already. Brazil and Argentina are 2 largest trading partners in South America. And then essentially all of Southeast Asia, you are likely to see action taken against. And that is worrying, I think, because one of the outcomes from the first bout of tariffs against China in the first Trump administration was that a lot of companies that were manufacturing in China or had supply chains that moved through China said, well, we got to reroute some of this. You can see the writing on the wall. It's going to be more expensive to do business in China when those products ultimately end up in the United States, whereas they're kind of a similar economic environment, labor environment, and shipping environment, Southeast Asia. So you saw quite a few companies move manufacturing to Southeast Asia. You saw quite a few companies move manufacturing or shift supply chains to Mexico. But it looks like those countries might be in the crosshair as well, based on this data at least. So that is quite worrisome. I would also call out, the safe countries, the countries in green, where we have a trade surplus, and they also have a average applied tariff that's very close to the U.S. average applied tariff. The U.K. And Australia, and on multiple occasions, the administration has said, in speaking about trade actions, that there might be exceptions to be made or deals to be had with the UK and Australia. And I think that's a reflection of how central they view the trade balance issue in their decision making. I will say, I think directionally this information is useful. This does not include non-tariff barriers, which is what we were just talking about with like the automobile regulations that are preventing U.S. automakers from exporting abroad, right? And so when you throw non-tariff barriers into the mix, you can get a different picture. I didn't do full map just because, like I said, Dan, it's super difficult to sift through all of the different regulations that these countries have that can limit commerce. There was some work done by Capital Economics. This is a chart from Bloomberg, which shows that when you apply a value-added tax, when you consider a value-added tax to be a trade barrier, and basically assign it a tariff rate, it does change the picture quite a bit. So you see the UK, which was a green country, low-risk country on that previous map based on just applied tariffs and trade balance. They all of a sudden their applied tariff shoots up to about 20% because of the way their value-added tax is constructed. And the value-added tax is something that's explicitly called out in the administration when it ordered its trade investigations. And so that's another thing for folks to keep in mind. It's just really difficult to predict how they're going to ascribe a monetary value to some of these regulations and tax schemes and foreign exchange policies that countries have.
So Jack, help me out here, because adding the value-added tax, I mean, it's not so much an American a concept that you see in the United States, but it's widespread across the rest of the world. And the point here being that when a country charges a value-added tax to a manufacturer that takes a raw material, a raw good, and processes it and makes it a finished product with a higher value, and then sells it, then the taxing authority collects a tax on that added value. That's what we're talking about with this value added tax, right?
Yeah, exactly. So we don't have value-added tax here in the States. It's essentially it's a tax that is applied at each stage of production. You've got that right. When value is added to a product. So sales tax, that's only charged in the final sale. That's what we do here. The VAT is charged throughout the supply chain. The issue with value-added tax and trade is that businesses they can deduct the value-added tax they've paid on inputs, and many countries that have a value-added tax, they refund the VAT if the good is exported, which means the product leaves the border tax-free. But when they enter the US and they compete with American-made products, those products have already been taxed domestically. And so that makes imported goods relative to US-made goods because there's no tax bill coming from the exported good. And then when we export products overseas, those American exports, they also get taxed at the VAT rate in the destination country, which can also make our products more expensive. So the VAT is basically it's an indirect tariff on imports,
Yeah.
and it subsidizes foreign exports through rebates.
Okay.
Hopefully that clears things up. I'm not a
Oh,
tax
it doesn't
guy.
clear it up at all. I
Yeah.
promise you. I mean, it clears it up to a measure for me, but I took international tax when I was in law school, so like all this stuff will come back to me. But yeah, trying to figure out the ins and outs, and I think that's one reason why the research is so helpful, because there's just a bunch of basic questions. It's like, I mean, just the most basic question of with the tariffs, who pays the tax, right? Because there's a technical answer about who pays the tax. And then there's a real world, well, once you figure out what everybody's economically motivated response to the tariff is, who kind of practically pays the tax, the answers to those two questions can be very different.
Yeah, I mean, I think, Dan, the bottom line with the VAT is, I would say I'm not here to educate everybody on how value-added tax works. God help
Yeah.
me if that's why I was here. I think the bottom line is, if we're trying to get a sense of what the administration is going to target, and we want to try and be able to make an educated guess about which countries might be high-risk countries for restrictive trade actions and how that might influence, how we think about investments and companies' risk exposure, you need to look at the VAT because it's something they've explicitly called out in the executive orders that underlie the beginnings of their trade policy. I think the other takeaway from the VAT, aside from the technicalities, is they're really dead serious about looking at the non-tariff issues when trying to assess tariffs on foreign countries. And so for a long time, we talk about trade, and with this administration, we talk about tariffs because that's their tool of choice. We talk about trade deficits because that's their metric of choice. But there is a lot of work going on behind the scenes to open up the aperture, open up the scope, and look more broadly at countries' economic policies and how they may be disadvantaging U.S. exporters. And the VAT is one of those, is an example of that for sure.
So I think that plays into a question that we've got on our Slido question submission area from 11 minutes ago, who asks, why use tariffs and not government subsidies and incentive programs if you want to stimulate domestic manufacturing, if that's what we really want to do? Why do we need to concentrate on tariffs? And if I just heard your answer, it's sort of like it's kind of a choice that, you know, the administration has a most favored tactic, but that there may be other things that they could have chosen to do instead or in addition to. And, you know, maybe we'll start to see some of that as we move past the first 100 days of the new administration.
Yeah, I mean, just like I'm not here to educate on the technicalities of the VAT, I'm not here to necessarily opine on why or why not they've chosen to use and focus on a particular tool, or to opine really on what their ultimate policy objectives are. I agree there are a lot of tools in the toolbox to stimulate domestic manufacturing. I think it's really important to keep in mind, to the point of the question, that many CEOs and certainly the majority of companies outlast singular administrations and singular policies, tariffs included. And another thing to keep in mind is that Congress, since 1934, and the passage of the Reciprocal Trade Agreements Act has slowly given away tariff setting authority to the president. And that makes tariffs very easy to put on, and it makes tariffs very easy to put off. And that makes making investment decisions, if you're a CEO, capital expenditure decisions, it makes them very difficult to base just on tariffs, because they are not sticky and the company will outlast the administration, right? So yeah, there are many tools, subsidies and incentives that can be used to stimulate domestic manufacturing. I think there's a vast body of literature that shows that tariffs don't do much to stimulate domestic manufacturing. There is a vast body of literature that shows that in instances when tariffs do help domestic manufacturing, it doesn't necessarily make the home country's product more competitive, because you're insulating them from external pressures. So you might be making something more at home. That doesn't necessarily mean that it's a better product abroad.
And indeed, often I've seen evidence that the domestic producers, rather than keeping their cost structure the same and taking advantage of a cost advantage, instead raise their prices to match the import price, accepting the same, you know, turning down a potential increase in market share in exchange for higher margins on the market share that they currently have. They come to the economic decision that is a better result for them than arguably kind of what the on its face, what the purpose of the tariff was, which was to try to increase the market share of domestic manufacturers in a given market. So it'll be interesting to see how that plays out this time as well.
Yeah, that's totally right. I just, maybe two specific examples. You know, at my previous gig, when I was looking at trade policy work in DC, we did a report on the new automotive rules in the USMCA versus NAFTA. And we interviewed a whole bunch of folks who worked in the automotive space. And we basically asked, you know, how much does trade policy, so the tariff rate that you're going to have to pay, and the content requirements to get your product across borders tariff-free between the US, Canada, and Mexico, how much does that matter for your decisions about where you're going to build your next manufacturing plant, whether it's assembly, whether it's stamping, whether it's putting together the suspension, the engine, parts manufacturing, whatever. Just how much does trade policy matter versus other things like availability and cost of labor, cost of regulation, dealing with regulation, access to labor. And everybody's answer across the board, every single auto manufacturer that we spoke to, regardless of where they sat in the company, said that the trade stuff doesn't matter all that much, because if you have to spend, hundreds of billions of dollars to set up a new plant and the labor isn't there, who cares if you're getting the product shipped across borders tariff free? You don't have anybody to build it. And so you can tinker around with trade policy a whole lot, especially tariff policy a whole lot, but there are kind of fundamental boxes that have to be checked before anybody decides, I want to sink billions of dollars into building a new plant in a country. And it's a decision that's going to take 5 to 7 years for the thing to be built and the lines to get spun up. We don't know what the policy is going to look like 5 to 7 years, because tariff policy in particular is not very sticky. And there's just a bunch of other decisions at play.
Yeah. And I have to say too, I mean, to the point on labor, you're in a place right now where you're seeing other trends that are having an impact on labor, especially in manufacturing, where you have technological innovation, you have a rise in automation. And so, it is a familiar thing to hear the political rhetoric of, if you increase manufacturing inside a country, you will benefit employment inside of that country. And yet, it may well be that manufacturing jobs are less filled by human labor than they were in the past, to the extent that technological innovation, automation, robotics, artificial intelligence start to take some of the inputs into the manufacturing process and change the balance between labor and capital in a way that favors capital and has less of an impact on the labor market than it did in decades past.
I think that's totally right. I think also, if you go to, I think, the 7th slide in that deck, Dan, we could take a look at, this is steel capacity utilization in the United States. And the top goes up to 85%. So keep in mind, we're never hitting 100% here. And you can see the trend when the steel and aluminum tariffs were put into place, end of 2019 up to full force. And then 2022 is when the United States started negotiating exceptions with a bunch of our major steel trading partners, where they could start getting their products back in tariff free. So obviously you have this big COVID drop off, but you do see like the tariffs did increase capacity utilization a bit. And since they've been removed for the most part, capacity utilization has dropped. But that is existing capacity, right? So like no one's necessarily building a new plant in the 2020 to 2022 time frame when the tariffs were in place.
Yeah.
And the trend is obviously influenced by a bunch of other issues beyond just tariffs. So with the steel and aluminum tariffs back in place, should we expect to see more capacity utilization? Probably. I think the aluminum side of things is super instructive. There are 2 aluminum smelters in the United States. They are both already operating they're both operating at half capacity, right? So they can increase their capacity, but there is, no guarantee that they're going to build another plant regardless of tariffs, just because the major thing that influences where you build a giant metal smelting plant is the cost of electricity, because these plants are so energy intensive. And then issues number 2 is probably tax policy. Issue number 3 is probably availability of labor. And then maybe you start getting to some of the trade issues. So does it matter around the edges? Yes. Is it totally instructive? I'm not sure that the evidence suggests that.
Yeah. I wanted to use a question that we got to highlight one of the tools that you produce, Jack. It's the tariff and trade tracker
Yeah.
that is taking a look at all of the actions. And, it seems like we get at least discussion of it from the Trump administration on a daily basis. And so having something that is updated from time to time can be helpful. The question came in from No Noise 18 minutes ago. Jack, what are your thoughts on the likely impact of Trump's tariff policies on U.S. agriculture? Will there be any winners in that market sector? And I'll just point out, I went over to the investigation tracker, and when you look at that in terms of agriculture, the targeted product, there's a column that breaks down the actions and investigations based on targeted products, and it looks like we're in a holding pattern to be determined, with that April 2nd date as the stated completion date for kind of the internal investigation and looking at the impacts of not just tariff policy, but non-tariff trade-based policy on the state of affairs in agriculture. At that point, maybe we get something in that realm. Jack, have you heard any rumblings or anything that can put the agricultural industry at ease, or should be raising concerns, or are we just not there yet?
Yeah, a couple points on agriculture in particular. I think regardless of what the administration does with this specific mention of looking into foreign countries' ag policies and why the United States has an agricultural trade deficit with certain countries, U.S. agriculture exports will be targeted by foreign retaliation, regardless of what that retaliation is in response to. So, for example, one of the first things the administration did was they added a 10% tariff on Chinese exports, on Chinese products, on top of the existing tariffs, and then they added another 10%, right? So there's an additional 20% on now from when they took office. One of the first products that China targeted in response were U.S. agricultural exports. The Europeans have a list of products that they might apply tariffs to at the beginning of April in response to last week's tariffs on steel and aluminum. Tons of agricultural products in that list as well. Foreign countries target U.S. agricultural exports because farmers are politically extraordinarily powerful. The farm lobby in Washington, D.C. is extraordinarily powerful. And geographically, they're extremely spread out in the country. And why that's important is foreign governments don't just draw up their trade retaliation, their trade countermeasure lists. They don't just pull it out of a hat. They target products and exports, U.S. exports, that they think will generate political issues for the current administration and for its supporters. And this is true Republican, Democratic administrations throughout all of history. Foreign countries use trade retaliation to generate policy leverage. They want to hit the constituents of the folks that are in power and make them rethink their support for that person. And farm country is definitely top of mind for them. So without even getting into the investigation into the agricultural trade balance, there's already a risk for U.S. agricultural exports and that sector overall. When it comes to that particular investigation, I mean, Dan, this is another issue where U.S. exporters just get caught up in a web of foreign food safety restrictions on GMOs, restrictions on pesticides, restrictions on how we treat meat, for example. Like Asia, huge pork consuming part of the world, but we just can't get U.S. pork. U.S. pork just can't get into a place like Taiwan because they have different health safety standard issues that are like a third rail in their political system. They just cannot manage to find a way to strike that type of an agreement with the United States, where the way that we treat pork would be allowed into the country. And so, you know, if you look at the past, when this administration was first in office, they had to do a farm bailout to keep farmers afloat during the trade dust up with China.
Yeah.
So I don't have a lot of optimism, I'd say, for U.S. ag coming out of this looking good. I will say, this is definitely something the administration is aware of. So part of the phase one trade agreement with China under the first Trump administration was a multi-$100 billion purchase requirement that China buy U.S. soybeans and a range of other agricultural products. So they do know this is an issue, and I think they see tariffs and trade policy as a tool of leverage to try and open up foreign markets to get U.S. products in. Whether they succeed in doing that, TBD. I think the prospects of export markets being limited for U.S. agricultural producers, pretty high likelihood would be my estimate.
Yeah, and the sensitivity, as you mentioned, the sensitivity of the agricultural industry compounded by the fact that margins are often quite low, that margins are highly volatile based on changing market conditions, changing weather conditions, productivity conditions. It's a very difficult to predict business, a very volatile business to be in. And, what may seem like a relatively minor change to policy can make all the difference when it comes to whether a given operation is going to be profitable in a given year or at a loss. And, I think that just about any farmer in any state across the country would be able to tell you their horror stories and their good stories, and like just how not random, because it's really not random, but it just seems all up to fate in some ways, that you do the best you can, and yet these external things that you don't necessarily have any control over suddenly come in and complicate matters, and maybe sometimes you get a windfall, but it seems like, from the stories that you hear, more often than not, it ends up being an additional challenge that you just have to find a way to that you have to overcome. You mentioned the farm bill, kind of the bailout, and I think that ties into a question Pro Shop guy asked 39 minutes ago. How much could tariffs generate revenue for the U.S. Treasury? Could it potentially replace other sources of revenue, like the personal income tax for U.S. citizens? I think that before I turn that question over to you, Jack, one thought that I have is just that I think you have to be really careful. A lot of people will just take the amount of trade that has happened in the past, apply a tariff rate to it, and say, oh, here's all this free money. And what they forget to do is account for the economic adjustments to behavior that people make in light of higher prices. And so any positive impact that you get from tariffs in terms of revenue coming into the tariff imposing countries' coffers is generally going to be less than if you just do the math and assume that that the flow of trade is going to be the same, because part of the impact of the tariff is to reduce the flow of trade. That's arguably one of the policy arguments in favor of it. And so reducing the volume of trade means that you don't have as much of a tax base on which that tariff is applied to generate revenue, that presumably then, yes, you can make redistribution decisions about what to do with that tax revenue. But, as you point out, sometimes you need to earmark that for the industries like agriculture that may be most affected by the inevitable reciprocal actions that other countries take.
I think that's totally right. And I think that is a huge issue for businesses that are trying to make decisions right now is what is the ultimate objective that the administration is trying to solve with tariffs. And so, Dan, I chair the trade policy committee at the World Trade Center in Denver, and this is something that comes up with the corporate members all the time, which is if we knew what the final objective was, we would be able to plan a little bit better because then there's a map, right, which shows when such and such has been achieved, the tariffs might come off, but until then, the tariffs will stay on. And this is kind of what we're trying to solve with the tariffs, so we get a sense for how long they'll be on. I think you have two conflicting objectives. You have using tariffs to raise revenue, and then you have using tariffs to solve the trade deficits. But the revenue from tariffs is generated because our deficits are so high. But if tariffs are seen as a tool to reduce the deficits, then you obviously wouldn't be generating as much revenue because you're not importing as much of the foreign good, right? And so you have those two objectives that are at odds with each other. It makes it really difficult for businesses to plan. In terms of could they generate revenue enough to replace the personal income tax, I think the math there doesn't necessarily work out. So the Committee for a Responsible Federal Budget, which is a nonpartisan policy research outfit, estimated that a 10% tariff on China and 25% tariffs on Mexico and Canada would generate about $120 billion over the calendar year of 2025. So that is not much in the grand scheme of the federal budget, which is measured in trillions. The personal income, individual income tax, I think makes up like over 50% of federal revenue historically. So
we're an order of magnitude off, I think, for personal, for anything close to personal income tax. You might be able to eliminate the estate tax or something, one of those little dinky things that doesn't really contribute that much. But the best you could probably hope for is some kind of tax credit that might or might not offset the higher cost of living that average American households are facing as a result of the higher prices that would come from the tariffs. It seems like to me, just again, back of the napkin, kind of just parsing this through off the top of my head.
Yep, I think that's exactly right. It is
So,
just yeah. Go ahead.
No, yeah, go ahead and finish your thought, and then I want to give you a chance to, if you have other presentation stuff. We've got about 10 minutes left, so I want to have I don't want to take all your time on anything that you have left to present.
No, I'm good on slides unless we need to fill up some time. I'm happy to keep answering questions. I would again just point out that even if if folks view tariffs as a potential source of revenue, tax policy incredibly difficult to work through in Congress in a way that's sticky. And again, trade policy, tariff policy, not so much. So even if there is kind of a tax windfall, there's no guarantee that it's necessarily something permanent or long term. And again, that makes planning very difficult.
Do you see any either short term or long term winners in the corporate world from the current kind of where we're going with tariffs at this point? JBL asked a question and kind of opined that, well, if you make it more difficult for auto manufacturers to use their existing kind of cross-border manufacturing construction type arrangements without incurring additional costs due to the tariffs, maybe that benefits the auto dealers that specialize in the used car industry, citing CarMax, which is ticker KMX, or Carvana, ticker CVNA. Do you think there's something to that? And are there any other examples that you can kind of think of off the top of your head that might be, again, like we don't know where this is going, so it's really hard to pick long-term winners, but just kind of where things are looking like maybe they're going for now. Any obvious winnings? Any obvious sectors that get at least a short-term tailwind from all this?
I mean, my first step in doing this type of analysis would be look at how some of the sectors that are being targeted again performed under the first Trump administration. So steel and aluminum, like U.S. Steel, Nucor, Century Aluminum. Check out how those companies performed at different stages of the tariff timeline for those products, and that could lend some clues in terms of how they'll perform now. Obviously, market conditions for some of those companies are changed, like the U.S. Steel and the acquisition back and forth. Wouldn't surprise me if that gets caught up with any trade discussions that occur with Japan. I do think, aftermarket, so used cars, that's definitely a sector that could see higher prices. Whether that translates into a more appealing stock, I'm not sure, because higher prices might be limiting for the number of people who can afford a new car or used car. For companies that don't move tangible products across borders, I'm glad that this was brought up, because one issue that the administration has revived trade investigation into, that it initiated the last time around, is an investigation into digital services taxes that Canada and a number of European countries, I think Turkey as well, a handful of others, impose on mostly US companies. So the way a digital service tax works is, let's say you're a company that does not produce a tangible product across borders. So Facebook or Meta, great example of this, discounting the VR headset. Like most of their revenue is services based, ad based, right? But because they don't have a physical product that they're selling outside of the United States, or selling in general, it's more difficult to collect a tax. So the way that countries have gotten around this, they set up digital services tax, where if a company generates a certain amount of revenue via certain means, ad revenue is a large one, data revenue collected from data is another large one, they're taxed. That a percentage of that revenue is taxed. And the United States believes, we have the largest online platform companies in the world. The Europeans call them large online gatekeepers, because they're so massive and difficult to compete with. Many of these digital services taxes are set up in such a way that those large US service providers are almost always hit. And this is not an issue that is unique to the current administration. The previous administration had a huge problem with this. They tried to settle it through negotiations at the OECD for a large global tax arrangement. That did not pan out. And so it's, I think, fair to say that companies that are more in the services sector are more insulated from the headline tariff news. It is not clear to me that they are going to escape all of the trade tensions unscathed.
Yeah.
The other thing I'll point out, in addition to digital services tax, is that foreign countries have really expanded their countermeasure toolbox, their trade countermeasure toolbox, to hit American technology companies. So the Europeans, they have a range of competition tools that they can use to hit American companies with regulatory penalties. It's the
Right.
Digital Markets Act and the Digital Services Act, almost explicitly, just in terms of how the characteristics are defined for a qualifying company, were built to attack the dominance that multi-sided tech platforms like Alphabet and Facebook and Amazon have. And so you can see more aggressive use of those tools in response to the US tariffs. And then China, obviously, as an American tech company, it's super difficult already to do business in China. But one of the actions they took in response to the most recent round of tariffs was to open up a new anti-monopoly investigation into Alphabet. So These companies, they might escape the headlines. There are still plenty of tools that can be used by foreign countries to hit them as a form of retaliation. It's definitely on their radar.
And it's hard to know. I mean, like the antitrust arguments for against these companies have existed for much of their existence, and so it's kind of hard to. I mean, you just have to look at the timing and attribute it to a retaliation against something versus just, oh, it just happens to come up at this time. I'm fascinated by things like a digital services tax because and let me ask you, Jack, I mean, is this in addition to whatever ordinary corporate taxes that American corporations might pay on foreign source income from the countries in which they are collecting that ad revenue, which under what I'll call normal international taxation guidelines would generally be something that a foreign country would be it would be a reasonable thing for a foreign country to tax that portion of income attributable to that country's source income.
Yeah, my understanding is that it is in
Got
addition,
it.
it is on top of it, and that is really the issue that successive US administrations have had. They just view it as, because the dominant technology companies are American, they just view it as really targeting US companies unfairly. And
It's, and it's a fascinating question. I mean, you talk about some of these things that like we think of them as kind of protecting the quality of the internet or something like that, and yet it may well be European policymakers fully expect these technology companies to keep violating these regulations that they set up, and they just intend to collect the money. Like there are set fines or set levies that penalties that come up, and they know that the company is going to do the economic analysis and say, well, yeah, we could differentiate and do all this stuff, or we could just pay $1,000 a day, per or whatever it is. They'll do the math, and somebody will make it, and then it really does kind of look like, well, maybe it's just some sort of trade barrier by another name, and then you just kind of spiral from there. You start asking, what the motivations are behind all of this. I think Bestie's question from 7 minutes ago, it looks like which I'm assuming means President Trump, wants to do tariffs and cut taxes. What is that? What are the objectives for these tariffs? Not only political are they? I think you can ask that question of every single action that you see in this area. You have to dig beyond the obvious to see kind of all the layers that are going on. And I suspect, Jack, even when you're in the room where it happens and talking to people who have this on their minds all the time, sometimes you still don't really know what the real motivation is or what all of the motivations might be.
sure, I think that's totally right. The Office of the U.S. Trade Representative, which manages trade policy, they put out their 2025 trade policy agenda last week. It's like a 5-page document. You can just Google USTR trade policy agenda. It is the perhaps the clearest kind of like philosophical underpinning for the administration's trade policies so far. And at the heart of it, they say that they want to revive, they want to use the country's economic leverage, tariffs of which are one tool, to revive what they call the production economy, which is really with the manufacturing economy. And they view metrics of success for trade policy as more manufacturing output, higher median household income, and balanced trade arrangements, balanced trade. So you could look at that document and say, those objectives are fairly clear. On the other hand, there's always a but.
Exactly. Yeah.
However, in imposing or threatening to impose tariffs on Canada and Mexico, the president did so under the International Economic Emergency Powers Act, right? And the in order to invoke that, there has to be an emergency in which action can be taken to resolve that emergency. And the emergency cited was not trade related. It was related to immigration and fentanyl crises.
Right.
So are there trade policy objectives that have been somewhat defined? I think maybe. Are they also going to use trade policy to try to achieve other objectives? Yes. And that is what makes answering this question really difficult, because there's the really bread and butter trade policy issues. We're going to use tariffs to bring back manufacturing, etc. But we're also going to use it as leverage for a bunch of other unrelated stuff. And that's what makes all of this unpredictable.